Hi, welcome to the First Trust ROI Podcast. I'm Ryan Isakainen, ETF strategist here at First Trust. Today I'm joined by Dave McGarel, Chief Investment Officer at First Trust. Dave and I are going to talk about where the market is, why it's gone up so much so far this year, what investors should expect going forward, and where there may be areas of opportunities even in the midst of what may be a recession ahead. Thanks for joining us on the ROI Podcast. Today, I'm joined by Dave McGarel, Chief Investment Officer at First Trust. Dave, thanks for joining us on the ROI Podcast.
Absolutely. Great to be here, Ryan.
So, Dave, you lead the team that is responsible for the analysis of our investments. You're more focused on equities than fixed income. And I will say this has been a year that probably nobody expected. 2023, I don't think the S&P 500 being up, 13, 15% was in anyone's expectation. So how do you explain, well, I guess first off, why the market has moved up as much as it has?
Sure. I think there's the interest rate hikes that are taking place historically have had long lags. And when you start from zero and you move higher, there's a lot of time for people to still spend all those excess savings, all that stimulus, and the effect of the rate hikes actually don't hurt very much until you start getting to higher levels. We're there now, and I think you're starting to see the effect of those rate hikes on consumer spending, on the pricing power of companies, and we would expect to see, if not a recession, some slower growth as we move forward.
So do you think the excess savings that people built up over the course of the COVID period of time, that's all spent at this point?
I think it's close to spent, and where it isn't spent, it's sitting in wealthier or higher income, higher asset value people who have more wealth are sitting on some of that excess savings, much more so than those at the lower income bands. So I do think we're close to the end of all that excess savings. But if you have a job, then you have the wherewithal to keep spending. You just have to use other avenues, start taking on a little bit of credit card debt, or, and this is what we think will happen, you start seeing some cutbacks.
So a lot of the performance in the S&P 500 in particular has been driven by a fairly narrow group of companies. People talk about the Magnificent Seven, some of those AI-fueled stocks, NVIDIA and some others. So in your opinion, is that likely to continue? Are we going to continue to have this narrow market, or do you expect some sort of broadening out in the months and years ahead?
Yeah, we expect it to broaden out. It actually is broadening out. That story is actually a March, April, May story where those Magnificent Seven companies, Apple at the top and Meta and Tesla in that basket, seven big names, and NVIDIA as well, and Amazon, they have done all the heavy lifting this year, but it was particularly in those 3 months where they just absolutely crushed the rest of the market. And by the end of May, those seven magnificent companies actually gave you all of the return of the index. The other 493 were actually giving you a negative return. And if you pivot to today, it is absolutely broadening out since the end of May. And now we see the rest of the S&P 500, even as the top seven are still doing fine, actually contributing not a negative percentage of the return, but more like a third of the return. So we would expect to see that continue to broaden as we move forward into this slower growth environment.
So valuations for those stocks, I know they're elevated relative to the rest of the S&P 500, but can you put some numbers on that? Where do we trade at for those largest companies compared to some of the others?
Sure. So the five largest, which comprise about 24% of the S&P 500. So imagine that. A quarter of the index is just in five companies, five great companies, but they trade at an average forward multiple north of 30 times, with the S&P at 20 times. Of course, because of their big weight in the index, they're also elevating that multiple for the whole index because they're trading at 30 plus times. So they're certainly priced as if we're in a different environment, in our view, an environment that existed 18 months ago. when long duration growth stocks were the only game in town, where everybody talked about TINA, there was no alternative to these companies, led with a little bit of FOMO, fear of missing out, as companies came public and enjoyed massive valuations without any profits. And so those companies have benefited from that environment. I think investors have just continued to reward those companies, but with a little bit too much of a look back instead of a look forward.
So it seems to me, and I know you've talked about this for the last several months as well, that there's some similarities between maybe the concentration in the market today versus the later part of the 90s. So can you talk about that a little bit?
Sure. In the late 90s, the market was led by a handful of mega cap companies, not all tech companies, but certainly Cisco Systems stands out, enjoyed at one point a $500 billion valuation. This is in 1999, a massive, trading at a level of sales, forget about profits, that was unprecedented. And that stock is not back to where it was in 1999 today. 23 years later. And GE, another example, I think GE actually hit $500 billion market cap back then as well, and today enjoys nothing close to that kind of valuation. So valuation matters. No one can see a slowdown in the best companies in the world, but invariably it does happen. And if you're paying just an extraordinary price for those companies, that's where you can get harmed, especially if the environment does change. After 99, we got through the Y2K scare that everything was going to stop in the world at midnight when we started in 2000. It didn't, and they enjoyed a spurt until the middle of March of 2000. And then from that point forward, all of those companies, many still really good companies, had to get repriced for an environment that was not going to be anywhere near as spectacular and much more focused on fundamentals and investing instead of just enjoying a ride that was detached from a fundamental picture.
And so the interesting part about coming out of the 2000, the dot-com bubble bursting in the next few years, for me anyway, is that there were a lot of stocks that were different types of sectors and factors that tended to perform well. So when you look back at that, what actually did better after those big stocks that concentrated in the top of the index kind of started to pull back?
Sure, of course. It was all about that secular long-term story of lighting up the internet and companies like Cisco benefiting from that back in 1999. And then when we pivoted and got through that period of March and the market did start to fall, and then we had the recession, and then the Y2, and then the 9/11 attacks,
Sure.
Exacerbating the 3-year downdraft in the market where we fell 3 consecutive years. Investors started to notice that if you're investing, you want to look at cash flows. You want to look at valuation. And where you found that were names that were nowhere near as prized as Cisco, but in the Campbell Soups of the world, companies that were started trading at 8, 9, 10 times, but were profitable and paid a dividend. And that shift during the recession was in value stocks. It was in companies that did pay dividends, yield, and even a little bit of size. The smaller mid-cap, smaller large-cap names actually started to perform better than just that mega-cap basket that had been rewarded all through 97, 98, 99 during what is now referred to as the tech bubble. But again, it was broader than just tech when you see names like GE with those kind of valuations.
So drawing that forward to today, none of us knows what's going to happen tomorrow, next year. Do you think that there's maybe an opportunity for some of those same sorts of better valued companies to maybe outperform going forward?
I do. To be clear, the basket of names at the top, the Magnificent Seven, almost across the board, they're magnificent companies.
Sure.
They're not just magnificent stocks that have given us phenomenal returns. They are great companies. They're a world away from the valuations and the lack of earnings power that existed with a lot of those companies back in the late 1990s. Now, we do have the 1,000 IPO plus that came in 2021. That is similar to some of the craziness that did take place back then. But the big 7 stocks, this time are high quality names. They're just too expensive in this environment. So if we look at the aftermath of the 2001, 02, that recession, and we go to 08, 09, again, you see the same factors at the top. Investors say, look, I need to take some risk off the table. I want valuation on my side, but I also want to see where there's cash flows, where there's positive earnings, where there's increasing dividends. And that's where you start seeing a different basket of stocks end up in portfolios as we get an adjustment across the board, but especially in names that are too highly valued for an environment that no longer exists.
So I think it's pretty clear that the Fed policy changes that have taken place over the last, 15 months or so now have had an impact on valuations, and the discount rate goes up and some of these companies' valuations go down. So two-part question. First off, do you think that the Fed is pretty close to being done or maybe done? And then, what sort of impact will Fed policy or interest rates in general have on valuations kind of looking forward?
Sure. So the best line I saw on this, a little higher for a lot longer. So 1-2 rate hikes perhaps, maybe more. If inflation rears its head again, the Fed will keep going. It will continually have an effect if we don't go anymore on the environment. When you think about a high rate environment, it's obviously affected homeowners and mortgages. Nobody wants to move because you don't want to give up your mortgage, right? So we've certainly seen the effect of rates, and higher rates can only have a bigger effect on economic activity. And that's what the Fed very candidly said. We want the economy to grow slower than it's capable of for a period of time. And Chairman Powell said, when asked what's it capable of, he said, well, we're right around 2% the last 20 years. So he wants slower growth than 2%. So when you think about going forward, if we're not going to have this uber growth environment, if we're not going to have the stimulus of low rates and just cash out to consumers, then you're going to really have to look at what you're paying for equities and where there's an opportunity going forward if it's not just going to be in the same basket in that different environment. Massive stimulus, low interest rates, and companies that could thrive in that environment.
So do you think earnings multiples will kind of stay about the level that they're at in general now, or would you expect, if policy stays stable, that you would drift one way or the other?
Sure. Absent earnings dropping, the multiple doesn't look that bad when we get rid of the top 7 names. And in fact, the top 10 names after the Magnificent Seven represent about 30% of the S&P 500 and trade at 30 times. But as soon as we start getting below that, 11 through 50 and 50 to 100 and stocks number 400 through 500 actually trade at almost 15 times. So much lower multiples just as you get away from the very, very top of the S&P 500. So those don't look overvalued. The question is, can earnings that have massively accelerated since 2019 actually maintain or grow from a level that in the S&P 500 is about 35-40% higher than it was just in 2019. And you would expect that some of that stimulus in the low rate environment helped the earnings growth and the pricing power from inflation for a lot of companies. So that's the real key is, will earnings hold? Forget about growing. If earnings hold at 215 this year from 218 last year on the S&P 500, and the forecast for next year is 240, and we actually only hit 225. That's a massive amount of profits for the S&P 500, like significantly higher than just 4 years ago in 2019. And that means a lot of excess cash flow to make sure you can keep funding that dividend, that you can reset your debt levels or just pay off debt if you need to, with rates now are 400 or 500 basis points higher on some of your bonds that are coming due. It certainly will hurt some companies as we move forward, but if we have that level of profitability, I think valuations outside of the very top of the index actually look okay.
So when you're looking at just sort of a broad basket of stocks, you mentioned some higher quality attributes. Is that sort of the sort of companies that investors should be more focused on today than just kind of buying an index? Should they look at more high quality names?
Sure, quality obviously is where you want to be when there's more uncertainty. So we like quality, of course. It's no longer cheap. The trade in the last several months has been a quality trade. Quality to us is really great balance sheets, low debt to equity levels, so that you know that you can withstand an environment and don't need to do as a company things you don't really want to do, but you're forced to because of the leverage that you're using, and then really strong returns on equity, return on assets for those companies. So those are the kind of companies that would favor be able to weather the storm as you move forward. But the real opportunity, if we slow down, if we go into a recession, is determine when you want to start putting money in smaller cap value stocks, which will get hit in a recessionary environment, especially in a hard recession. But if 08, 09 isn't on the table, and we don't have any valuation levels like we did in the late 90s, then the opportunity to get in a little bit early, if you can stomach it, is clearly in some of those small cap profitable companies that might be trading at 8 or 9 times earnings and significantly below the large cap. And that's an anomaly. I know that's what's existed over the last 10 years where big is better, but historically, the big return has always come from small cap stocks over large cap stocks.
So preparing for kind of what's ahead and recognizing that you're not likely to time perfectly when a recession's coming, when it's going to end. You think that, just sort of building in some of those biases towards smaller companies might work out well. I think that worked out pretty well in the previous time period. We were talking about coming out of that dot-com bubble bursting in 2001, 2002. So you think it's kind of a similar setup?
Absolutely. I mean, look, every day we go to bed, somebody owns every one of those equities. It's not naive people who own an equity when your environment isn't perfect. The market has priced in, to some extent, this slowdown. That's why you see stocks that do trade at 8 or 9 or 10 times earnings that have a history of profitability. They happen to be more in the small and mid-cap land today. They happen to be in the value side of things because growth and technology and consumer service, communication services are so exciting, and they've delivered the best returns. So invariably, we all look backwards and see great returns, and we chase those returns. But when there's a big shift, and that's what we see today, the Fed is telling us, hey, we're going to slow it down. Like they were full steam ahead for quite a long time. When they did try to slow it down in 2019 or 2018 and raise rates, immediately in 2019, at the first sign of any weakness, they cut rates. Not this time because of inflation. So we do think if things got soft, they would cut rates, but not when we see an unemployment rate where it is today, multi-generation lows. I've never seen an employment rate much lower than it is today. But when that starts to move up, maybe we'll see some rate changes. And I guess the pat answer would be, well, if the Fed does cut rates, then you've got to jump right back into those long duration growth stocks. I wouldn't think so. I think there's a lot of other companies that are going to benefit if the Fed does cut rates. And a lot of investors are going to notice these companies in the high single digit or low double digit multiples that have profits and are raising their dividends and are quality companies. So I think that's an opportunity. You're right, even if you do get in early.
What do you think about some of the defensive areas of the market? I know that's something that people have kind of gone back and forth on a little bit this year. Coming into the year, it was something that was somewhat popular after the swoon that we had in 2022. The markets rallied some, so maybe some people have abandoned the defensive areas. And I think they were somewhat expensive at the end of last year. So what's your take on some of those defensive areas today?
Sure. So when you talk about defensive in the S&P 500, it's primarily healthcare, more so consumer staples, and certainly utilities. Sure. Those are the three big defensive areas. Healthcare has enough growth in it that it's not entirely defensive. Consumer staples certainly is defensive, but it has enjoyed such massive pricing power. If you listen to conference calls and CEOs, the ability to increase their prices and not see any demand destruction at all has been prevalent for the last 18 months. That's probably fading. It certainly looks like it in the numbers. So those enjoy pretty high multiples. So it's hard to get excited about consumer staples. With healthcare, at least you have some of the growth and you have a decent valuation, along with an earnings outlook next year that shows that healthcare should be one of the top sectors when it comes to earnings growth. And then you get to utilities. At least for the first time in a long time, utilities are priced, in our opinion, like utilities. The difficulty with utilities, every investor in the last 10 years has used a utility as a bond proxy. You can't buy bonds, there's no yield. Well, buy utilities, take a little bit more risk, but low vol risk, and utilities will continually give you a little bit more in dividends and dividend growth every single year. They're finally at a spot where they're valued lower than the market, not at a premium, which they shouldn't be because we know their growth is not going to be great. And so they're starting to look attractive. Certainly in a harder recession, a bigger slowdown, those defensive sectors will hold up better, but they won't give you necessarily positive return. When the Fed does cut rates, that would be the first signal to say, okay, at some point we may be using utilities as a bond proxy again. And you might see investors say there's some value there. Those dividends are going to be there, and maybe I can get those before they reassume perhaps a slightly higher multiple.
So the other sector I wanted to ask you about was the energy sector. This is a area that did very, very well for a stretch, especially following the spike in oil prices when, the Ukraine war started. And this year, energy's sold off a bit, but more recently has actually started to perform a bit better as oil prices have moved up. So what's your outlook for the energy sector, not just over the next few months, but really over the next few years?
Sure. Energy is one of our overweights. Right now, we do like the energy sector. There's a small weight in the index today versus where it was 10, 15, 20 years ago. In 1980, the S&P 500 had 20% of its market cap in energy names. Today, it's closer to 4.5%. So it's certainly, we've seen energy become a much smaller and less important part of the index over the last 40 plus years. But they enjoy very little competition today. We see high oil prices. The transition from fossil fuels is taking place, but it is going to be at a much slower speed than many want, or maybe many expect. But the absolute truth of it is that there's a big, big developing world out there with 4 times the amount of people in the developed world. The developed world is trying to find solutions for using less fossil fuels, but they're not going to be able to do that and export that across the rest of the developing world that need cheap, reliable sources of energy to have better food, shelter, healthcare, better lives for all their citizens. And so it would be hard to expect those developing countries not to use the same resources that Western civilization used to make our lives so much better. So we're going to continue to see an increase in the amount of oil used per forecasts for the next decade, going from slightly about 100 million barrels per day today and to maybe 107 million barrels per day used in the globe is the expectation 10 years from today. And without more capital being invested in new companies or in exploration, you're going to see higher oil prices for quite a long time. So we think that's a sector that you definitely want exposure to.
Yeah, I mean, it seems the fact that companies are a bit disincentivized from investing in long-term capital projects because, there's the thinking that there's going to be a transition and maybe regulations will tighten and maybe you're not going to get a payback on these projects over the next couple of decades. The supply seems like it could be a bit constrained relative to the increasing demand you're talking about, right?
Sure, and I think shareholders have spoken loudly. You look at those companies and what they've done with their dividends and stock buybacks recently and rewarded shareholders. And the stocks have gone up massively. Energy's been a phenomenal trade for the better part of a couple of years now after it hit massive lows. I think it maybe hit below 2% of the S&P 500 during the COVID period of time and then snapped right back. And what they've done is just make their balance sheets fantastic. But yeah, the reluctance to invest is coming from the shareholders. They're saying, well, we don't know what's going to happen. Let's not invest this money. Give it back to us. And that's what those companies are doing. And now they're in across the board. The S&P 500 energy sector is in a phenomenal position when it comes to their balance sheet strength, being able to rid themselves of debt, increase those dividends, and then doing what so many companies have been doing the last 10 years, but now they can do it themselves, is buying back stock and rewarding their shareholders with a bigger share of the company and the future profits.
So higher oil prices obviously feed into inflation as well. Inflation was, 9% last year. It's come down quite a bit. What's your take on kind of, the next several months? Do you expect that inflation will kind of moderate back to a level and stay there? Do you expect it to, kind of reaccelerate? What's your take?
I don't know that I have a great perspective on if it's going to reaccelerate. I don't think the Fed's going to hit their 2% objective. I think it's going to be higher for longer on inflation. They may live with that. We'll see what effect that has. But I would be surprised if they will get this thing back to where it had been before. And that means that rates are going to stay somewhat elevated. And we're not going to be able to grow as fast because the Fed is going to be worried that if they're going to settle on 3 and wink and a nod, that if it's 4, they still have a problem. They're going to have to go higher. So I would expect it to stay above average for quite a few years going forward. And that's why we think rates, again, will be above average. We just enjoyed an incredible period of time where rates had no effect. Actually, they had a massively positive effect on investing capital in better return projects. And they're going to get a lot harder to price and determine if you want to invest your capital when the risk-free rate has gone up as much as it has.
So for someone trying to figure out their expected returns over the next several years, would you say that they should plan on having, for equities we're talking about, lower expected returns than we've had over the last decade?
Sure. We're starting from a standpoint today where we are at 20 times next year's earnings. Even if we take the top names out and we get to a number closer to 17 or 18, that's not multiple expansion opportunity. 2019, 20, and 21, the returns were phenomenal, 31%, 18%, 28% on the S&P 500. That's 100% cumulative return in just 3 years. So what we wrote this January in our market minute was that we would expect over the course of this decade to see something closer to a 7% return or so on equities, something closer to 70% over the next 6 years or so when it came to the total cumulative return of the index. So more muted than history. No multiple expansion opportunities. That's when you see a decade and you look back, you say, well, big reason for that excess return was because of the starting point and how cheap stocks were. Nobody liked them. Nobody wanted to buy them, but they were extremely cheap. And when you see a decade where the market underperforms, it's because we started at or above those longer-term multiples. So I think we're in that environment today where we're going to be at or below those longer-term returns because of valuation today. And then, of course, an environment that does not speak to the TINA trade. There's no alternative to stocks. There's a lot of alternatives today to get real return.
So what does that mean for international stocks? Because those are cheap and those have underperformed for a while. Should we expect better returns for international stocks going forward? I mean, I believe our models are still pretty much either underweight or at weight for international stocks. So as you think about the next several months or next several years, is there an opportunity in international?
Sure. I don't think it can be worse than the last decade. You're exactly right. It's just a disaster, international space. And as you look forward, it's really hard to identify a catalyst. If you think our oil prices and gas prices are high, just go over to Europe. They're just multiples higher than we are. So they hurt the growth of those economies as well. So it's hard to see those countries and the rest of the world growing much faster than the U.S. China has its own problems. So there's not a great catalyst to say, I want international exposure. But what's interesting is we know that the U.S. is the dominant economy in the world. 25% of the world's GDP sits right here in the U.S., but that means 75% sits somewhere else. And those are citizens of those countries who are trying to improve their lives and going to work every single day. And it's 75% of all of the GDP in the world. And I think to ignore that and the opportunity there, when you do see incredibly cheap valuations, when you're actually seeing some stock buybacks in the European countries for a lot of those stocks right now, because their stocks are so cheap and so depressed that there must be some sort of an opportunity. If nothing else, here's what we know about the rest of the world. The U.S. is the technology giant, and in my opinion, nobody's in second place. There's not a country that can come close to the U.S. and its technology footprint. But what that means is the rest of the world is a lot more cyclical, a lot more defensive in many cases than the U.S. economy when it comes to their stock markets. And so you can actually take the international story today, the international basket, and in many ways actually make that part of your value content as you move forward. That's cyclical, defensive, because they just don't have the technology that we do, where our technology versus cyclical footprint in the S&P 500 is actually much heavier in tech than, or tech plus, as we call it, than just the cyclical trade.
Okay, so final question for you, Dave. As you kind of think about where we are today, what makes you optimistic looking forward about our industry, but just in general?
Sure. Well, I mean, I'm an optimist anyway, so that's helpful. I see all the discord politically between both parties and all the cancel culture and everything else going on in the world. And when you really think about where we sit today, we have absolutely wonderful lives. I mean, we live in a world that has never had as many benefits for human beings as we have today, whether it's food or clothing or healthcare, shelter, across the board. We have in many ways eradicated a lot of the poverty around the world in the last 40 or 50 years, and it's due to capitalism. And there's no threat to capitalism. There's no threat to the U.S. being the dominant superpower in the world right now. And when you have basically a democracy, where you have those, this is Jim Bowen, personal property rights, the rule of law, a functioning democracy, you can't do anything except grow long term. You just grow long term. That's what happens. And so we'll get through this hiccup in the road or bigger bump or a little bit of a valley, and then we'll come out of it. And the story of equity returns, it's not your house that provides the greatest return in the history of the world. It's always been equities, and nothing has ever come close to equity. So if you could stay the course and focus on the longer term and buy throughout any type of recession in the equity basket, you're going to be rewarded with some fantastic returns. It's so hard to do emotionally. So you set a plan in action, and that's really going to reward you. And so that's what I'm so optimistic is people understand that. We try to deliver that message. Don't think about tomorrow, think about 10 years. And in 10 years, the stock market is going to be significantly higher. Earnings are going to be higher. Our lives are going to be better. And I don't have any inkling that that's not going to be the case.
All right. Well, that's a great place to leave things. Dave, thanks for coming on the First Trust ROI Podcast. Really appreciate it. Thanks to all of you for joining us as well.